You've drawn higher highs and higher lows for years, called it an uptrend, been right about direction more times than you can count, and you still lost money inside trends you correctly identified. Here's why. A higher high was never the information, it was the leftover, the final score of a fight you never actually watched happen. This is the disciplined trader. What you're about to hear doesn't add a new concept on top of what you know. It corrects the lens you've been looking through the entire time. Here's the belief almost every trader carries that structure means higher highs and higher lows, and drawing the pattern correctly is the analysis. A trader marks it perfectly. Higher high, higher low, higher high again, goes long on the next higher low. The trade still fails, not occasionally, often enough that the pattern itself starts to feel unreliable, so they get more precise with the drawing. The results don't improve at the same rate. That's because a line connecting two prices tells you a pattern existed. It doesn't tell you why. The battle that produced that high, who punished, who folded, what it cost, happened in real time and left no visible trace except the line itself. A high high is not a signal, it's a scoreboard. I don't need to ask whether you can identify an uptrend, you can. Anyone can. What I need to ask is a different question. When that high high formed, did you know who created it? What it caused them? Whether it was conviction or desperation? The shape can't tell you that. Only the story behind the shape can. There was a period where I could draw structure perfectly on any chart you handed me, and I still lost money trading with a trend I'd correctly identified. The shift happened when I stopped asking, is this a high high? And started asking what had to be true about buyers and sellers. For this candle to close exactly where it did, the structure didn't change. My relationship to it did. Now, structure as a record of control. Every swing high and every swing low is the result of a battle. Buyers pushing, sellers pushing back. At some price, one side stopped being able to continue. That price becomes the swing point. There are two scenarios that produced an identical looking high high. In the first, buyers overwhelm, sellers with genuine force, expanding range, aggressive closes, real size behind each push. In the second, price trades slowly into period high where resting orders are known to be clustered. Thin candles, a grinding push, no real expansion. The high forms not because demand was strong, but because that level held available liquidity. Price traded through. Both produce the identical shape on your chart. Both qualify as a high high by every definition you were taught. The structure is not the analysis. The structure is the evidence the analysis is built from. Internal breaks tells you a smaller battle was won inside a larger one. External breaks tells you the larger battle changed hands. Where the breaks happens near liquidity, away from it. After compression tells you whether the win reflects order flow imbalance or liquidity absorption. Now, the single clean sequence. One chart, one structure break, two readings. Read 1 takes 5 seconds. High high confirmed. Uptrend intact, bias bullish. Read 2. The break occurred after 8 hours of compression. Strong displacement, minimal wick, commitment, not hesitation. It happened away from any major resting liquidity consist, with genuine buying pressure, not liquidity absorption, dressed up as one. The sellers who shorted the old high are now trapped on the wrong side, and their forced exits are about to add fuel to continuation. Reading 1 identifies a pattern. Reading 2 identifies a battle, who won it, and why the win is likely to hold. You were not drawing a structure. You were keeping a score of a fight you never watched happen. Every high high you marked, every high low you trusted was the final number on a scoreboard from a game played before you opened the chart. The shape was never the information, the shape was the leftover. And the moment you start asking what the battle actually cost, the chart stops being a drawing. It becomes a witness statement. That gap between seeing a shape and reading a story doesn't close by trying harder in the movement. It closes with a habit, which is exactly what happens next. Before this video, a high high means the trend continues. After it, a high high means someone won a specific battle. And now you ask what that win was made of. You don't stop drawing a structure. You stop trusting the drawing as the analysis. Mistake 1. Treating every structure break as a equal evidence. A displacement break shows wide range, minimal wicks, a strong close force, a liquidity break shows a thin candle. A long wick, a wick close. Absorption, not force. Same label, different evidence. Mistake 2. Drawing a structure without asking what it cost. Moving straight to is this bullish skips the only question that matters. Go to any chart, find the last 3 structure breaks. For each one, write one sentence. What had to be true about buyers and sellers for this candle to close exactly where it did? Go look at your last stopped out trade inside a trend you'd correctly identified. Was the structure wrong, or did you never ask what the break actually cost? Tell me which one it was. Once you are asking what a break cost instead of just labeling it, the next question is unavoidable. How do you tell in real time whether a break was earned through force or extracted through absorption before the rest of the move has already happened? Market structure isn't a drawing exercise. It's a story of institutional interest and intent. You don't need a new tool. You need a new question. What had to be true for this candle to close exactly where it did? If this is the work you are doing, stay on this channel. New episodes 4 times a week, each one building on the last.